Okay, let's jump straight into it. Welcome to your Ultimate Exam Revision Masterclass. Today we're completely decoding the IGCSE Accounting 0452 module, focusing on ratios, liquidity, and efficiency. If you're gunning for that A-star grade, you are absolutely in the right place. In this explainer, we aren't just looking at basic record keeping. We're going to build that crucial bridge between basic data entry and high-level financial intelligence. Let's get started. We've got a solid game plan today. We'll start with core accounting concepts, move into step-by-step technical execution, tackle evaluating financial ratios, and finally wrap up with examiner tips and pitfalls. All right, part 1, core accounting concepts. Let's recap the basics you absolutely need to know. To kick off, we really have to establish the rules of the 2026 syllabus. Using outdated language, that will instantly cost you marks. You have to transition to modern international terms with 100% accuracy. So we're saying irrecoverable debts instead of bad debts, and owner's equity. You need to memorize these right now because precision in your vocabulary signals to the examiner that you are a top-tier candidate. Now, if an exam question uses the command word state regarding the absolute bedrock of your records, you need the accounting equation, assets equal liabilities plus equity. You've got to understand the application of the business entity concept here, ensuring every single entry has a corresponding reaction. That equation has to stay perfectly balanced at all times during the fiscal period, no exceptions. You are also going to be frequently tested on the prudence concept. This is basically testing your ethical financial judgment. If you ignore potential losses and overstate your profits, you're directly violating transparent financial reporting. Always anticipate potential losses, but never anticipate profits before they're actually realized. It's all about keeping the business's financial reality transparent for the banks, the owners, and the tax authorities who rely on these records. Just to round out our core concepts, make sure you know essential vocabulary like accrued, prepaid, realization, and consistency. But here's the catch. Don't just memorize definitions. When you see the IGCSE command word apply, it means you have to integrate these concepts into complex trial balance adjustments. Just knowing the definition? That's a C-grade skill. Applying it to adjust a trial balance? That is your A-star skill. Okay, moving right along to part 2, step-by-step technical execution. Let's look at how we actually work through these problems. Listen, in the IGCSE examination, method marks are your absolute best friend. They are awarded even if your final balance is completely, totally incorrect, provided your logical flow is visible to the examiner. So remember this golden rule. Show absolutely all of your workings, whether you're dealing with depreciation, inventory valuation, or correcting errors. If the examiner can see your logic, they'll reward you for it. To get that flawless execution, you have to follow an exact chronological workflow. It all begins with identifying the correct business document, like an invoice or a credit note. That acts as the source for your books of prime entry. From there, you move into your T accounts, and finally to a balanced trial balance. This is the exact sequence that gives you a seamless transition into the final financial statements. Now, let's look at a super common calculation trap. When you're asked to calculate final amounts, be incredibly careful with discounts. Miscalculating the order of trade discounts versus cash discounts is a classic mathematical pitfall that catches so many students. You must always deduct the trade discount first before applying any cash settlement discount. Seriously, don't let a simple percentage calculation steal points from your paper. And moving into the ledgers, T accounts are the gold standard for representing the double entry system. You have to completely master the distinction between your balances. We're talking balance BD, which is brought down, versus balance CD, which is carried down. Mixing these two up at the end of a fiscal period will completely throw off your trial balance, and you definitely don't want that. Next up, part 3, evaluating financial ratios. This is where things get really interesting. Let's make this explainer a bit interactive. I want you to pause right here and attempt to answer this using the exam command word evaluate. Why did the current ratio fall from 2.5 to 1 down to a risky 1.1 to 1? Calculating that drop is easy, but what is exactly happening behind the numbers? Take a moment, actually write down your answer, and then press play when you're ready. Okay, let's see how you did. To score top marks on an evaluate question, you needed to dig into the underlying causes. Did you mention that the business might have overpurchased inventory, tying up all their liquidity in unsold stock? Or maybe they're settling trade payables way too slowly. Perhaps their cash reserves were just completely depleted by a massive capital expenditure. This is the kind of high-level financial intelligence examiners are demanding from you.
Furthermore, evaluating ratios often requires inter-firm comparison. If an exam asks you to compare two businesses, but one uses the straight line method of depreciation and the other uses the reducing balance method, well, a direct apples-to-apples comparison is basically impossible. You must explicitly state how those differing accounting policies affect the final valuation to really determine which business is performing better.
Finally, Part 4, Examiner Tips and Pitfalls. Let's talk about where students usually go wrong. Here is a massive, completely avoidable warning straight from the principal examiner reports for 2024 and 2025. Students often lose marks simply through poor handwriting in ledger accounts. I know it sounds silly, but if the examiner literally cannot read your numbers or distinguish your balance C/N, you simply won't get the credit. Your brilliant financial logic means absolutely nothing if it's illegible. Take the extra second to write clearly. Another huge red flag highlighted in recent reports is the failure to explicitly distinguish between revenue expenditure and capital expenditure. Treating a capital purchase as a day-to-day revenue expense will completely warp your final profitability figures. It throws everything off. Make sure you're categorizing these items with absolute certainty. As you finish your exam, you need to look beyond the surface calculations. Examiners want to see you question the quality of the profit. Ask yourself about the long-term sustainability behind the business's return on capital employed, or ROCE. A high profit margin this year might look fantastic on paper, but is it actually sustainable in the long run? Because ultimately, the true health of a business relies heavily on non-financial factors that are never, ever captured in the accounting records. Things like staff morale, the physical location of the premises, and the overall market reputation, those are vital for long-term sustainability. So I'll leave you with this final thought for test day. How will you evaluate the true, complete health of a business when the most important factors aren't even written in the ledger? Think about it. Thanks for joining me on this explainer, and best of luck with your revision. You've got this.